You finally did it. It's April 2026, and you just signed the contract for that six-figure promotion you've been chasing for years. $100,000. For decades, that number has been the ultimate psychological finish line in America. It was the defining marker of comfort, the undisputed definition of having made it. You were supposed to be set, but you don't feel rich. You don't even feel comfortable. In fact, when you look at your bank account after your promotion, you feel broke. Today, we are analyzing the anatomy of the 2026 middle-class trap. This is not a debate about feelings. This is a precise mathematical reality. If you live in a major U.S. metropolitan area, or even one of the accelerating mid-sized hubs, $100,000 is no longer a luxury income. It is a mandatory survival salary. The goalposts for financial safety haven't just moved. They are on a rocket ship, fueled by dynamic 2026 hyperinflation in essential core sectors and a newly solidified low-hire job market. The reality is simple. Your hard-earned high income is evaporating in real time. Over the next 6 sections, we're going to look at exactly why your money is disappearing, ranging from the quiet utility spikes hitting Americans this month to the new AI ceiling on your personal wage growth. We have to identify the trap fast, because the 2026 economy is structured to keep high earners locked into mediocrity, consuming their potential through essential costs before they can ever build true wealth. If you have been wondering why you are working harder than ever but falling further behind, this is the explanation you've been looking for. Imagine being told your salary is keeping pace with inflation right before you open your utility bill, which just jumped 35% since 2024 due to the massive under-discussed aging grid surcharge that was finalized last year. This is the core CPI fraud. The Consumer Price Index, the number the government uses to calculate your cost of living, is a basket of goods. When the official reports state that inflation is cooling, they are often factoring in falling prices for imported electronics or apparel. But the problem is, you don't buy a new laptop or smartphone every single month. You pay for electricity, healthcare, and food daily. The quiet inflation of 2026 is concentrated precisely in the items that are mandatory for middle-class existence. While digital goods have stabilized, we are seeing electricity rates in major U.S. hubs surge as the grid handles AI-powered demands. Healthcare premiums are seeing unprecedented renewals, and childcare costs are rising to a normalized standard of $2,000 per month in many areas. This discrepancy is the foundation of the middle-class trap. Your salary is fighting a losing battle against a non-discretionary basket of goods that the official CPI doesn't accurately reflect. The evaporation of your paycheck isn't a figment of your imagination. It's occurring daily through your utility meter and your grocery bag. When the things you must buy to survive go up by double digits, it doesn't matter if the price of a television goes down. You are being squeezed at the point of necessity, and for a $100K earner, that squeeze is starting to feel like a stranglehold. If you earn $100,000, you are supposed to be able to afford a home. Yet the single greatest driver of the middle-class trap in 2026 is the American housing freeze. The rules that defined the previous 40 years of wealth creation. The idea that you save for a down payment and purchase a home in a good school district have been effectively suspended. Interest rates, which stabilized at 7% in late 2024 and 2025, have created a landscape where no current homeowner will sell. Almost everyone with a 3% mortgage is functionally locked in. This means the supply of existing homes is non-existent. Without supply, prices remain astronomically high even as rates stay elevated. The concept of the starter home in any viable economic hub is gone. In 2026, the traditional debt-to-income ratio used for mortgage qualification is laughably outdated. Securing a modest $500,000 home today requires a monthly payment that consumes 50% or more of a six-figure net income. Middle-class earners are now left with an impossible choice: rent indefinitely at peak 2026 prices, which are increasingly siphoned by corporate landlords, or purchase a home that leaves you house poor. Being house poor in 2026 means every single discretionary dollar is consumed by interest taxes, and insurance, leaving no room for savings, retirement, or unexpected repairs. Your high salary isn't buying you an asset. It's buying you a massive liability that prevents you from ever getting ahead. This is the brick wall of the middle-class trap. But perhaps the biggest psychological shock of this month happened just 2 weeks ago on April 15th, when middle-class earners across America realized they could no longer tax deduct their way out of a financial squeeze. On tax day 2026, the middle-class safety net vanished. We are now experiencing the full expiration of the temporary tax credits established in the early 2020s, which previously cushioned many high-earning families. Simplifications to standard deductions and changes to the child tax credit mean that people who previously received a significant refund to pay down debt or build an emergency fund saw those funds disappear. Simultaneously, bracket creep is finalized. Your recent salary promotion may have pushed your entire income into a 24% or 32% marginal tax bracket, forcing you to pay significantly more income tax, even though the buying power of that salary has sharply decreased. High tax rates on an eroded dollar create the definitive financial squeeze. The safety net is gone. The result of this year's filing was a wake-up call. Instead of getting $4,000 back, many 100K earners owed $4,000. This is the new baseline. High income, high essential costs, and high taxation create a financial system with zero tolerance for error. When you combine this with the fact that many states have also increased their local levies to cover infrastructure gaps, the six-figure earner is effectively being taxed like the wealthy, but living like the working class. You are working for the government and your landlord, and there is very little left over for you. AI didn't take your job in 2025. You are still employed, but AI integration, which became mandatory across tech, management, finance, and creative roles, has introduced the most insidious threat to your income, the new AI wage ceiling. When standard AI copilots and automated productivity tools became normalized in the workplace, they allowed a single employee to effectively do the work of three. In 2026, companies are leveraging this productivity not to pay you more, but to keep wages flat. They aren't passing the efficiency gains on to you. They are absorbing them into corporate margins. This has created a unique low-hire, low-fire job market in white-collar sectors. Your current high-salary role is safe, but the days of jumping from one company to another for a 30% salary increase are over. Because every company now uses the same AI efficiency models, salary scales have become standardized and stagnant. You are expected to produce more value than ever, but you can no longer leverage that efficiency into personal income growth. This is the ceiling of the trap. You are safe in your job, but you are stuck. Your income is frozen, while the cost of housing and utilities continues to rise. In the 2010s, you could out-earn inflation by being a high performer. In 2026, performance is automated and the premium for being better has been eroded by algorithms. You are working at peak efficiency, but your bank account is at a standstill. If you are working remotely from an expensive hub like New York, Los Angeles, or Seattle, and complaining that $100K feels like $40, the cold reality is you are choosing to stay trapped. The first and most powerful weapon in the 2026 exit strategy is geographic deflation. In 2026, remote work is not a pandemic experiment. It is the fully normalized structural labor foundation of the US economy. The smart money is moving now. You must leverage this normalization to save your financial future. Moving your stable $100,000 income from a high-tax state with peak rents to one of the 9 no-income tax states, like Texas, Florida, or Tennessee, instantly grants you a 10% raise before you even look at housing costs. Combining that tax saving with the dramatic reduction in housing cost from geographic deflation allows you to execute an immediate 30% jump in disposable income. You cannot wait for your company to give you a raise that matches the 2026 cost of living in San Francisco. It isn't coming. The exit requires you to move your income to a location where it still carries its historical weight. Remote employment normalization means your salary can finally reside where your expenses can stabilize. If you refuse to move, you are agreeing to the terms of the trap. But if you move, you transform $100,000 from a survival wage back into a wealth-building tool. To complete your 2026 sovereign exit, you must pivot away from outdated investment models and build what we call human premium income. The first step is creating a secondary asset that AI cannot duplicate. We are moving from digital commodities to physical premiums. In 2026, the unique human capability to command trust in a physical space commands the highest premium. This means building skill-based expertise that requires a physical presence or specialized human empathy. Things like niche trades, precision consulting, or high-end physical service businesses. If your income relies solely on a screen, you are at risk. If your income relies on your hands or your presence, you are a sovereign. The second step is the Roth pivot. The 2026 Roth IRA limits are higher, and in a world of unpredictable tax policy, tax-free growth is the only guarantee of future wealth preservation. You must max your Roth contributions before any other discretionary investing. If you exceed the income limit, you must use the backdoor Roth maneuver. Your wealth must be structured in vehicles that are shielded from future bracket creep and tax hikes. The middle class is shrinking, and being a high earner is no longer enough to guarantee safety. In April 2026, you must become an intentional wealth architect. You have to stop playing by the old rules of the 2010s and start playing the game as it exists today. The trap is real, and the walls are closing in, but the exit is visible for those willing to take radical action. Take control of your money, move it to where it's treated best, and invest in assets the machines can't touch. That is how you survive the 2026 squeeze.